All right. Well, welcome in everyone. This is an amped introduction. So, we are going to be talking about how we partner with you to make long term investing biblically sound, safer, and click button simple. We have a couple of opportunities that we're going to present to you throughout this presentation to share with you a little bit more about exactly what all this entails. So feel free to ask questions, those of you who are live, if you have any of those. And we have a great team that is involved in the program. I am the director of AMPT. My name is Jeffrey Nance. And then we have Ben Russell, Jenny Taylor, Denny Foster, and David Verbrugen. They're going to serve as your investment advisor representatives. So those that move forward with us, and we have some that are on with us that have already joined in the past that just like to join in and hear what we have to say. You're going to be working with these guys. They're going to be staying in contact with you, and you're going to work with them throughout your time together here in AMP. So they're going to be on with us as well. They'll be answering some questions there in the background, and we appreciate all of them. And we'll go through and tell you a little bit more about some of the various roles that these people have. So most of you guys are probably wondering, especially if you're new, what is AMPT, which is a very great question to ask. And it's assisted managed portfolios by TRADEway. So no room for the buy there, but everything else fits. So assisted managed portfolios by TRADEway. And this is where we're going to come in and essentially help you in your long-term investments. And we'll talk about this towards the end when it comes to what type of investments are we able to handle, and is this for you? We're going to walk through all of that, but we really just want you to know more about who is doing what so that you can make an informed decision on how you might want to move forward potentially with the AMP program and the various ways that we are set up to help you achieve your financial goals. So appreciate you guys being on with us today. I'm going to turn this over to Ben Russell as he's going to lead out in a lot of this, and then we'll have some back and forth as we kind of walk through this material. But I appreciate Ben and his involvement with this program. He's been here since the beginning, him and Jenny both. So we appreciate them and their work that they do in this whole thing and what they've done through the years to put this program together as David Mitchell worked with them to lead out in these pursuits. And so I took over doing some background stuff about, I think the summer of last year, and then started handling more of the day-to-day trading decisions around September of last year. So I'm excited for the changes that we've made in the program and for what I think that's going to be able to do in the future. So we appreciate you guys being here today and look forward to giving you more information about this program that we're really excited about and think it has a really great opportunity moving forward to do some cool things.
Awesome. Well, Jeffrey, I think that, as we get started, hello, everyone. I'm Ben. I'm glad to virtually meet you today. And I'm looking forward to exposing, with Jeffrey and I and the rest of the team, what really is AMPT? What is it about? And I think this presentation is going to really help answer a lot of questions. Now, obviously, there will be some questions that we can't address in this conversation, but that's okay, because at the end of this presentation today, we will give you an opportunity to sign up for a personal consultation with one of our investment advisors. You see, that's the key here. There's some complexity here in this investing world. And what our job is as investment advisors, we're trying to make what's complex simple. We, together with you in partnership, we help you to figure out what's some ways in which we could build a portfolio to help to manage your goals. And that, if you look at it, AMPT, we're assisting you with managing your portfolio, but we're doing it with TRADEway's methodology. TRADEway's methodology backs up what we're doing, but the foundation of that is scripture itself. And that is the real power for us in our organization, is that it is a biblically based portfolio management strategy. We take Ecclesiastes, we take Ezekiel, and from these key passages that actually talk about money, David Mitchell, our founder, our president, the chairman of the board, created this AMPT program. And I love what David says here. My job with the AMP program was to protect all of my friends, all of my students, all of our clients from the dangers of buy and hold investing. And here's a quote from David Mitchell. If you've not met him, his picture is down there at the bottom. David has a great way of sort of, cutting to the chase of what's really important. Take a look at what he says here. I've always been amazed by Wall Street's universal habit of leaving people's money in the stock market all the way to the bottom of a bear market. Now, I think if you've been involved in this world for any period of time, you've probably heard buy and hold, buy and hold. Well, I think our team, David Mitchell, we would say that that's dangerous. And Jeffrey, we're going to talk a little bit more about this, but the reason why we think it's dangerous is here in this chart. Now, it's a bit of an eye chart. I hope you can see it clearly, but that dark blue line represents when did the market go down and how much did it go down. So for example, I'm just going to go to the largest one here. Let's take a look here. So October, let me see if you guys can, let me pull out a laser pen so you can see. All right, so here, October of 2007. Do you guys see that laser pointer there? If you see October 2007, the R means that it was a recession. So there was an economic recession, and that economic recession caused the market to decline 56% in value. That's not a typo. 56% of the portfolio value evaporated. And then this next bar, this blue, light blue, how long did the market decline? 17 months, over a year, approximately a year and a half. I mean, at some point, you probably would have figured out that the market's going down. You need to do something different. But oh no, most investment advisors are going to buy and hold. Now, this orange is really telling, Jeffrey. This is the part where I think it tells a story that we need to make sure everyone hears. After the market declined, it took 49 months to get back to even, not to make a profit, to get back to even. So if you put the math together, 17 months of decline, 49 months to recover, what is that? 66 months.
Mhm.
66 months of our investing life evaporated in a bear market.
Wow.
I don't think I can sustain that, and I'm not a young man anymore. That's not acceptable for my own portfolio, much less the people that I'm helping. What do you think, Gio?
Yeah, I think this is really fascinating to see this, and specifically to see, well, how much of a decline, because the bear market is a 20% move. So that means, the S&P had to move at least that much. And then I think it's really cool to kind of see, well, how long did that last? And then how long was the recovery, and to compare a couple of these things. But, certainly I think everybody remembers the, 2000, 2007. Um, and then I think some of the more recent one, Ben's, people have tended to forget about because they've ended relatively quickly. So the last one that we had that lasted any real length of time was in 2022, and it lasted about really a year, and that was the longest one that we had seen in quite some time. A lot of the other ones prior to that had just been over so quickly. You can just see the one in 2020 was only a month, and then all of a sudden we're recovering, but it took 5 months to recover. So and 33%, pretty significant drop there. And probably most people are wondering, well, when the next one occurs, how big is it going to be? Is it going to be one of those 20%, which I think if we average all these out, we probably would be around, what do you think, Ben? Maybe 25% or so, maybe a little bit higher.
Well, Jeffrey, what you'll notice is that the big ones have the R next to it. It
Yeah.
depends on if we go into a recession. And there's actually quite a bit of talk that we're likely overdue for a recession economically. And there's some concerns about what Trump is doing, that we could, in fact, be moving into recessionary territory just because of all the changes that are happening economically. So we could be due for a big one.
Yeah, and I think what's big about this, Ben, is historically the market has recovered and actually
Mm.
gone higher than where it was previously. That's certainly been the case for our last several bear markets. But again, one of the things that we've tried to do to really differentiate ourselves from other people is to say, what if you don't just ride it out? Like,
Right.
what if, is there because it doesn't even seem like it's not a common thing to say, well, is there another alternative? And that's one of the differences that we really have tried to create here with this AMP program is there actually is a different approach that you don't often hear about. And it's a big part of what we do.
Yeah, I'd agree, Gio. And I think David's onto something here. If you look at the fact that, it took 56 months to recover to get back to even, and it took 49 months to recover to get back to even, think about what that means for the time frame of the recovery. They were very, very strong bullish moves. So
Mhm.
what if we could have a system that helps to avoid the really large declines and then be prepared to take advantage of the really strong moves with a lot more of our capital preserved? Well, that's exactly what David's created in this system. And it's what we're going to be telling you more about today, because that really is what we're trying to do. We're seeking to invest with this biblical framework and a mindset that allows us to couple a trader's understanding of the market. You see, markets move in longer term cycles. And if we can look at the charts and look at market tone and align our investment objectives with the portfolios to that, well, we think that's how we can allow history to become more of our guide. What do you mean by that? I mean, we can look back at the bear markets that we just saw, and we can see that through history. Some of them were stronger, some of them were weaker. We kind of need to know why. Typically, they're about recessions. So, we as a team, a grouping of people that you see together on this webinar, our goal is to help to invest based on the tone and the cycle of the market. What's the news? What's driving it? What's causing things like recession? That would be tone. And then what does the chart tell us is happening? That would be where we are in the cycle of the market. And what do we want to do? Well, we want to manage this risk. How? Well, we're going to have bullish portfolios, we're going to have squirrely portfolios, and we're going to have bearish portfolios. And Jeffrey, our friends might not have ever heard that term squirrely before. What's squirrely all about?
Yeah, I'm glad you paused right there, Ben, because that's not what we would call an air quote industry term.
No.
So, most people will just say we're either in a bull, and then all of a sudden you look up and you go, oh, apparently we were in a bear, which somewhat of the irony is you're not really in a defined bear market till it's already dropped 20%. So I was like, well, what were we in while it was dropping?
Mm.
So it wasn't officially a bear, but it certainly wasn't bullish. So are we just bullish until all of a sudden we get transformed into a bear at 20%? What we like to draw out to people is that no, there actually is this transitional period where sometimes you're not really in a bullish environment, but you're not really in a bearish environment. And so we added in another animal and we called that one a squirrel. And if you guys, paid much attention to squirrels, it's like, is it going all the way across the street? Is it going to get halfway across the street and turn back around on us? It tends to get like very volatile and quick, and it can be up and then down. So in those times, we want to be a little bit more conservative in our approach in case it does end up turning into a bear, then we're already better suited to maintain a larger portion of your money, which again would be great if we do see it turn into a bear market. Or the cool thing that we have is the ability to adapt, Ben, and say, you know what? This isn't going to turn into a bear market. Let's go ahead and move back into bullish positions here. But it was okay that we were a little conservative during that stretch because we would rather be conservative during that stretch than have you lose more of your money in case it did turn into a bear. So we kind of have three different scenarios here where we would really think through how can we take the most care of our students' money and put them in the best spot to have more long term.
Gio, it's the important thing to recognize is the AMP program allows us to leverage these methods and the foundation of the biblical wisdom undergirding everything that we do. Well, it's how we can help you to build a custom portfolio that helps to meet your investment objectives. And you'll often hear us, Jeffrey, and in fact, if you meet with one of our advisors, we'll use this language with you of, let's use this as our first starting point to start to develop a portfolio with you. We like to call it the 80-20 concept. We want 80% to be long term, invested with more diversified methods. invested with a little bit greater safety than some of the other things that we might be teaching you to do in the trading world. So when we look at investing, we typically see it as a less volatile opportunity, a lot more diversification. And what we're going to try to do there is align to those cycles that we just talked about. And when we can invest with the cycles, it really gives us a much it's a little easier for us to be able to kind of sleep better at night. And I don't know about you, but when it comes to my portfolio, I like to be able to sleep at night. I don't want to take too much risk when the market's not clear. And I definitely don't want to be involved in equities when the market is dropping. This allows us to have that, what I like to call the sleep factor. So that AIM long term, that 80% money, if you will, we call it AIM, AIM. I'll tell you in just a moment, but the AIM portfolio, the Advanced Investment Management portfolio, is diversified. We're investing mostly in assets that are ETFs and sectors. And we do recommend that based on your risk tolerance, you let us help build a portfolio for you that allows us to be in sectors of the economy that have the greatest odds of potentially going up in the next time frame. Now, if you're doing the math, you've got 80, well, what's left over? There's 20. Well, the 20% would be where we together get to decide how much do you want to actively trade, more aggressively actively trade. This isn't as diversified as the AIM long-term money. And what our goal, what our hope is to be able to take smaller parts of our capital and more aggressively trade those small investments with the potential of having higher returns on that smaller money. It's a very unique way. And Jeffrey, I've not seen a lot of other advisors that will take this approach of blending investing and trading for their clients. And it's pretty unique to TRADEway.
Well, and they, in some ways, are a little bit of a different skill set. So we are, a little different in that sometimes, you can really kind of look at the market in a short term and go, well, it seems like it's headed down, but then long term it's still going up. So why this, discrepancy here? So a lot of times it really does boil down to the time frame that you're considering. So yeah, there are certainly
Mhm.
times when we can take advantage of some bullish type moves, even in a bearish or squirrely environment, and we're wanting to do that, and we have a couple of different avenues, of course, for you to do that with us in the context of these programs.
So you've probably, if you've been to our step one seminar, you probably heard that 80-20 concept at step one, where we teach how stocks work. We're using that same method here, friends. So what we're going to do now is we're going to transition into showing you a little bit more depth. How do we do the 80%? How do we do the 20%? What do those long-term allocation models look like in the AIM program? And the diversification, how does that work? Now, one thing, Jeffrey, that I think really helps our friends sort of solidify the difference between the two is we're just talking about the time frame. One is long
Yeah.
term, one is short term. What do we mean by long term? Well, typically it's weeks to months in a position. That's what we mean by long term. And our portfolios are designed to try to hold those positions for a longer period of time. Who's on the team, Gio?
Well, we have a few people, and you guys kind of saw them at the beginning there. So you can see me there in that kind of striped shirt, I guess, there, plaidish kind of thing. And then we have Jenny Taylor and David Verbruggen and Ben Russell as well. So those are the folks that are on an ongoing basis making decisions as to what we should be doing with our long term, what we call our AIM portfolio. And that has to do with the positions that we're entering, potentially exiting. So we're working together to think through and make decisions on that. So we've got not just one person's input, but a
Mhm.
team of people that are giving their input and then helping essentially me to make those decisions on what we should do and when. And then we have several people that are helping us actually get into and out of those trades within a very short time frame. Again, so that ability to be very nimble is a very cool thing that we have the ability to do here with our processes.
So Jeffrey, is what As we think a little bit more about what is that team doing, there's guiding principles for every part of our program. And I like to tell people that our two guiding principles when it comes to the long-term money, protect the capital and grow it more safely.
Mhm.
That's really what it comes down to, the long-term goal. We're not trying to knock it out of the park with the long term. Still trying to make good returns, but we're not trying to knock it out of the park because we're first trying to protect the capital. So our first goal is protect the capital from those huge market declines, because what we know based on the previous charts that we've seen is the real money is often made in the next year of the next
Mhm.
bull. So that's our goal. We want to protect the capital when we're not clearly in a cycle that we can identify. Growing it during the bearish cycles is also an opportunity, Jeffrey. We'll talk about that in just a moment, but I haven't heard too many
Yeah.
other advisors talk about trying to grow capital in a bear. Huh, very interesting. All right, so point number two, growing it more slowly. Diversification, Jeffrey, means that we're not able to always put the funds in just the hottest sectors, because that means we would not be diversified. When we talk about
Yeah.
our long-term funds, we want diversification, which means we're giving up a little bit of the opportunity of the potential gains for the opportunity for greater safety. So that diversification means that we're likely not going to see the same sort of returns that we would in a more aggressive portfolio. So what does a potential create here, Jeffrey? David Mitchell likes to put it this way. This is a quote from David Mitchell. In his opinion, generational wealth can be created by having the skill sets to avoid the bear markets. That's the thesis here. So AIM is about protecting the capital, trying to grow the capital more slowly with diversification so that we can protect and allow ourselves to be very well positioned when everybody else is trying to get back to even. Let's go take advantage of those really strong bull markets that historically tell us are coming right after the bears. So what is this picture telling us here, Jeffrey? What are we doing here within this bullish model?
Yeah. Well, what's really great about this, Ben, is that we allow the clients to determine their investment. So we have four different categories that you would work with your investment advisor representative to determine based on, well, a number of factors. It could be age, it could be your risk tolerance, it could be, your need for money at a certain time, or your ability to just really hold on to capital. So you're going to work directly with that IAR to work through this process and then to determine, well, which one of these categories do I want to be in? So I have an aggressive, I have a growth, I have balanced, and I have conservative. And you'll be able to determine which one you want to be in. And the really cool thing about this too, Ben, is that you don't have to just stay in one for the next 30 years. There might be lives that things that happen to you in life where you say, you know what, I want to be more aggressive during this stretch. I want to be more conservative in this stretch. We're always going to be trying to look out for you and keep you in a place that's helping your money grow, but also protecting that money. But you might say, yeah, I think this is a new bull market. I was in a fairly conservative mix during that bearish run. Can I switch over to an aggressive mix, and what is that going to look like for me? And yes, we want you to know about that. So we need to make sure that your risk tolerance aligns with the category that you're in, but it will impact maybe how you see a certain market or how you think through your personal risk tolerance, and our ability to put you into certain positions that are matching what you're telling us you want to achieve, or your willingness again to take risk inside of that portfolio.
Yeah, it's awesome to recognize, Gio, that this is a collaborative effort between us. Between you and your investment advisor, you get to help build this portfolio and these mixes together based on your risk tolerance. And it really is about what's that diversification ratio look like. You see, we're going to take more risk in the stock-based investments of the portfolio. So we get to choose how much do we want from your risk tolerance perspective to go into these more aggressive sectors of the economy. And then we kind of defray part of that risk by putting a certain percentage that we together decide into these less risky parts of the economy, things like fixed assets. We have some T-bills periodically. We've been paid pretty well on those. We've got several dividend-based funds, Jeffrey, that have been performing very well and paying a really nice, consistent monthly income. Right, so we're defraying some of the risk in the portfolio by blending these two categories together. Now, that's the bullish side. Now, as we think through, we already have talked about it, but we move from bullish to squirrely when we're not confident with what's going on in the market. What does that really look like? Well, it's about getting more defensive. What do we mean? Well, we can sell off some of the stocks in the portfolio. And we do that because you're giving us discretionary trade authority in your portfolio. We click a few buttons within the models. It starts to reduce your allocations in the stock. We're going to start to increase the allocation in some of the things that we call defensive sectors. Jeffrey, what do we mean by defensive sectors?
Well, there are certain opportunities, industries, if you will, Ben, that are going to do better or maintain their stability in certain markets. So
Mm-hmm.
we have some what we call ETFs. It's not we, it's industry, exchange traded funds. And we're going to be able to move in and out of certain positions to move you into what we might consider during a certain stretch. Again, in this particular situation, a more conservative approach to potentially a bear market, or at the very least, a significant shift from clearly bullish market tone into this is kind of interesting. So that's what we'll be able to do. And then essentially it's more into a cash or cash equivalent type of position where you could actually be making some money through dividend paying ETFs, which we have several of those. And so that's money that could be coming in for several of the ones that we're in on a monthly basis,
Mm-hmm.
where regardless of what's happening in the market, you might be seeing some money coming into your account as a result of being in those positions.
Yeah, and Jeffrey, I think the part that gets really fun is just to consider we've given you three portfolio types. We talked about the bulls, markets move up. Squirrely, we're not real sure. Well, if things were squirrely and it comes back to bull, well, you know what? We just go back into the bullish allocation. Things got squirrely again. So we're going to go into the squirrely allocation. And, normally it takes one or two of these kind of bumpy cycles before often the market rolls over. And then we know it finally went from squirrel to bear, and it's time for us to change because we want
Yeah.
to preserve the capital, right? Number one on our list is preserve the capital. And here's our bearish portfolio. We're going to invest in things that have the opportunity of preserving the capital. And if you have an aggressive risk tolerance or a growth risk tolerance with us, we do something that's very unique, Jeffrey. It's called an inverse ETF.
Mhm.
Huh? Inverse what? What is an inverse ETF?
Yeah. So this is kind of, I think, probably weird for some people that might, basically be being introduced to some of this terminology. But essentially, Ben, most people, I think, consider when the market is dropping, because almost everybody they know, when the market's dropping, they're like, well, we're all losing money. Which, if you think about it, some of those bear market conditions you listed, if you walked around, probably talked to your neighbors, talked to your coworkers, they're like, oh man, this is brutal. Like everybody I know is losing money. So something we often don't think about is, well, if I just walked around and dropped $100 bill in a room, did that $100 bill disappear? It didn't disappear, Ben. What did it really do? It changed hands. So for most people that without really thinking about it, they're like, oh, I just thought everybody lost money because everybody I talked to lost money. No, money exchanged hands. So while for a majority of people that are unaware of the opportunities that exist for them, they go, oh, I just thought everybody was losing money. I didn't even know there was an alternative. What they don't realize is that there are actually opportunities for you to make money when the market goes down, which is kind of like, what do you mean make money when the market goes down? That seems very weird, but these inverse ETFs are actually set up so that they gain value when the market drops, which is kind of weird to think about. There's an instrument out there that actually increases in value while everything else decreases in value around it. And so we have the opportunity based on, again, the particular entry that you have, either aggressive or bull. Now, this is not going to, if you're either in the balanced or conservative, we won't be doing the inverse with you because it doesn't really align with your risk tolerance. So we're very keen on paying attention to those kinds of things. But in aggressive in growth, we would actually allow you to not just kind of come out, let's just say maybe even or up a few like 2, 3, 4%, Ben. You might actually be able to make money. And the deeper the market drops, the more that these inverse positions would make, which is really wild to think of. So some people, most people are losing money. You might be essentially, let's just say all you did was break even. That would still be way ahead of somebody else who lost 10 or 15% or more. You're already 10 or 15% ahead of them. But what if you actually made money and you were up, 5 or 10% while everybody else around you lost 15? And then imagine doing that, Ben, because these cycles repeat over time. Imagine doing that over a 10 or 20 or 30-year time period, how just even something like that has the potential to really impact your account over a long stretch of time, like 10 or 20 or 30 years.
Jeffrey, you're so on track with what David Mitchell, many of our mentors is trying to get us to recognize is the long-term management of these funds by avoiding these bear market declines. His quote: "This is how you build generational wealth. You've got the opportunity of doing that across multiple generations, and that's how David feels that we should approach the markets with the mindset of trying to build generational wealth for us and our families." And avoiding those bears is what David says is the key to being able to do that. So, Jeffrey, it was a great conversation in the long term. Let's talk a little bit about the short term, because now we're talking about the 20% money, if you will. And that 20% money, which we call the ultra portfolio or the up account. Yes, we tried really hard on that acronym too, right? So the up account or ultra portfolio is all about short-term trading. And when you meet with your investment advisor, me or one of our other members of the team, we can talk about what does it look like for us to help you to build a portfolio. What, why is that important? Well, you might have a lot of your funds in a 401k that you really don't have a lot of bearish options in. You don't have a lot of the choices that maybe we have here at TRADEway within our program. So what some clients will do is they want us to take an allocation in the ultra portfolio where maybe their 20% money includes part of what they have in their 401k. See, we want to have a holistic approach to your portfolio, not just what you have here with us at TRADEway. Let's think about your portfolio from a holistic standpoint. Your investment advisor, we can have those conversations. We can start to figure out how much should you be willing to put into your trading account to let TRADEway take a little bit more aggressive stance with that portion of your portfolio funds. So who is it that manages the up trades? Well, Jeffrey, you, I, and Jared, we get the opportunity of doing the up trades, but this is kind of interesting. We're not just in trades for weeks to months at a time. I mean, some of these trades can happen pretty quick, can't they?
Yeah. So what makes this a little different is this is more, if you'll think of it as trading opportunities. So these could be, a couple of day trades. They could be a couple of weeks. If we caught one and we really thought, man, this thing is still so amazing, I'm going to ride this thing out. We certainly have the ability to do that. But in the up portfolio, we are looking to make shorter term trades to really take advantage of these market moves, whether it's up or down in some ways, but primarily we are, generally going to be focused on the upward move, which is good because more often than not, the market does move up. We've been talking a lot so far about, how to protect yourself when it moves down. But this also provides an opportunity with some of the um, tools that we have available to us to be able to take advantage, even in a run down, of making money in those shorter term moves, or even in the what I like to call the geysers, which even in a bear market, when the market's dropping, you're going to see these really big numbers, and you're kind of thinking, "Oh, wow, that's a really big drop." But there tends to almost always historically be these wild little short-term recoveries. So something like up would certainly be able to take advantage of some of those when we felt like, hey, at least for a day or two, this thing might be going up. So this is an opportunity for us to be in what we would call, active trades, looking for opportunities on a daily basis to consider opportunities to increase the funds in this up trading account.
So that's the real power of what up is. So we're taking more risk with a smaller portion of the portfolio. So while the long term is about preservation, the first goal that we have in this part of the portfolio is to take more risk. Now, it's an educated risk. It's the same things that we teach you to do within our trading programs. We're going to leverage individual stocks. There will be limited options capabilities for clients that have portfolios above 25,000, but conditions have to be right for us to do options. And our goal is to attempt to grow these funds faster by more active trading than what we would typically see in a diversified portfolio like the AIM account. Every trade has a plan. Not all trades work. If you've been with us for any period of time, you know that. Not all trades work. So just like what we espouse to you, we follow the same rules. We have a trade plan. We know what our stops are. We know what our profits are. We've got a plan and a reason to do it. And as things shift, well, you'll see that we're typically going to be a little bit more reactive in this portfolio, in the ultra portfolio, than what we would be in the AIM, the long-term portfolio. So for us, combining these two together gives us a great opportunity to kind of have a little bit safer investing opportunities that we typically see in the diversified portfolio for our long-term money. And then we're going to take more aggressive stances with short-term trades in the ultra portfolio to build a blend and a model to help you with your investment objectives and the risk tolerance that together you and your investment advisor get to determine. So what do we do with the ultra portfolio? Well, it's three of us that are doing the trades. Each one of us has 33% of the portfolio, and each one is documented, and we hold each other accountable. We define the stocks based on what it is that we're looking for. What was the reason? Why do we do the trade? We hold the positions when they're in a pattern, and we stop out more quickly. We take profits pretty quickly too. And our goal is to try to recycle the profits back into new trades that are at a great buy point. And it helps us. Why? Well, because by controlling these trade sizes, what you're going to see, Interactive Brokers, by the way, is going to send you a message. Every time we do something in your account, they tell you we did it. Complete transparency. And you'll see, we often will get into a position with 2.5% of your portfolio. And then, as the trade works, we'll get in with, an extra 2.5 or up to 5. We may balance that all the way up to a 10% position in your portfolio. We can either sell the whole thing, scale it back. We've got a lot of flexibility with our tools to scale in and out of positions based on what they're actually doing. Yeah, pretty good stuff. So, Jeffrey, we leverage Interactive Brokers, and I think it's really key that our friends understand why. They are our partner. They're that critical to what we do because they give us the tools, Jeffrey, where we can click the buttons on our friends' portfolios as if it was our portfolio. That's really important. And there's one other factor here that I think is amazing is Interactive Brokers is paying when we're in cash and we're not really sure what's going on, those more squirrely times, they're paying near CD rates when we're in cash.
Yeah.
That's an important difference because most investment advisors will tell you they can't go to cash because they don't get paid anything. That would be true. Less than 1% is nothing. Our current rates as we're doing this session now, as we're recording here at the beginning of 2025, the rate is just under 4%. How do they get that? It's based on the Fed Treasury rate. So whatever the federal funds rate is, minus 0.5, that's the rate that Interactive Brokers is going to pay you. All right. So that's the key. And the opportunity that we have now is to leverage Interactive Brokers. And as we do, I just want you to recognize that it's their tools that let us do this. It really is. And it's,
Yeah, Ben.
what's that?
What I would say here is, it's not like it's, hey, you're going to make 0.0% either. Like this is pretty significant. So we don't really have an issue with thinking of cash as a position. In fact, that's a phrase that we'll use is sometimes cash is a position. And you mentioned earlier, I think something that's a really big deal is that these rates weren't too far behind a CD. So if any of you guys have been in CDs, I've done that, and through the years, and these rates were not that far off of those, and you could move it straight out of that into a position at a second's notice. There isn't, a 3-month or a 6-month or a 9-month or a year-long lock-in. This is just, it's just sitting over there. And if we decide we want to do something with it, then we'll go do something with it. But until then, it's making us a little bit of money.
Yeah. And I think it's really important to recognize that a lot of advisors who have a buy and hold mindset have it because they don't have an alternative. but we have an easy to implement alternative where we can get out of a position with a click of a button. It takes us a matter of minutes to reallocate these portfolios with Interactive Brokers tools. And because of that, we can implement the portfolios that we have been describing to you. You see, we can go in and by your risk tolerance and with the cycle of the market, we can create with a few clicks of the button, the buy and the sale orders across hundreds and hundreds and hundreds of accounts based on your account size. It's pretty masterful to watch it. The tools are incredible. So IBKR allows us to manage these trades. And the other thing I find just very powerful is they create what's known as a batch transaction. Now, if you've traded for any period of time, you know, sometimes the fees in these transactions can be kind of stout. Not so with Interactive Brokers and the batch transactions that we get. See, we have these capabilities in the background where it kind of gets grouped together as one large bulk trade. We get very favorable rates on doing the trades. The other day we did like a $22 million transaction. It was less than $800 in fees across the 22 million. A little piece of that fee got put on every single person's account. Very small fees compared to a lot of the other vendors that do this in the business. Most financial advisors, when you go to make a change in your longer term portfolios, they're going to charge you to do it. And then there's also going to be brokerage fees on top of that. That's not how we do it, friends. That's not how we make our money. We do not make money on transactions. We make money based on assets under management. It's designed to help us and to help you. Why? Because it aligns our objectives with yours. Your objective is to protect and to grow your account. Guess what? Our objective, because of how we get compensated for the help, is the same thing. We're now incentivized to help you to align those objectives. We do better when you do better. It's not about the fees that we get from doing transactions. Oh, one more thing. TRADEway is going to pay the professional market data fees. So many of you, if you have an LLC or other entity, you've already figured out paying market data can be very expensive. If you want us to manage your LLC, we can do that. And then we pay the professional market data fees. So Jeffrey, let's bring this together. All right. So we've talked about the two parts of our program. The aim is the long term. It's based on David's biblical model. We call it the 8x16 program. And again, often we're in positions weeks to months at a time. It's all technical. We're looking at the charts. We're looking at market tone, and we're allocating your portfolio with your risk tolerance. And it's our team that's pressing the buttons. Long-term investing for the busy investor, I think that fits pretty well. Most of our friends, you don't have the time to press the buttons on your portfolio. Why not let us do it? And then in the short term, that ultra portfolio is a pretty powerful opportunity. Short-term trading in and out of the market, typically held for days to weeks at a time. You want our team to help you to take a little bit more aggressive risk with a smaller portion of your capital. That's what UP is designed to do, that managed short-term trading. So what does this look like? So Jeffrey, I think we might have some friends who are ready to get amped working for us today. And we're going to make it pretty easy. If you're on this webinar today, and Jenny, if you wouldn't mind, why don't you go ahead and launch the poll for me? If you're here today and you would like for us to meet with you, all you got to do is answer the question that we have here on the screen in front of you. What we want to be able to do is to be able to spend a little bit of time just asking the question, are you already an AMP client? No or yes? Are you already working with one of our advisors? Click on the button that corresponds if you are, and if you're not, you'll see down at the bottom that there is, I'm not currently working with an advisor. The reason why this is important is I want to be able to allow our team to serve you by scheduling an appointment with you. And our technology is how we're going to do it. We're going to use the technology to make it really, really easy for you to be able to schedule an appointment. Now, one thing that I think is really important here is that if you're watching this as a recording after the fact, or maybe you're in your car while you're listening to this, you can go to TRADEway.com, our website, TRADEway.com/AMPT, AMPT. And you can sign up for an appointment there, or you can always email us, amped@TRADEway.com as well. What happens after that? Well, our team is actually going to spend some time trying to schedule a meeting with you, and we make it really easy. You can schedule an appointment on your schedule at a time that's convenient for you. All right, so Jeffrey, as I'm looking at this poll, we're going to go ahead and keep this poll up and running. And I want to transition now to where we can talk about the team of people that you're going to be scheduling a call with. If you don't mind, Jeffrey, I think we need our friends here to be able to help us out a little bit. I've got a couple of leading questions I'd like to ask. So, hey, Jenny Taylor. Hello,
Hello.
Jenny. So, Jenny, you've been with us for quite a while. You've met with an awful lot of clients. How do we make it easy for our clients to schedule a call with us?
Yeah, so if when you answer this poll that you're interested and want to meet with one of us, what's going to happen is you're actually going to get an email as well as a text message with our scheduling link in it. So you're going to be able to click that scheduling link and then go select a day and time that works for you. And then we ideally we want to be able to meet on Zoom because we might want to share our screen or share just the steps, different steps we would take you through and answer your questions. And we can see you face to face with Zoom, and we like to do it that way. So that's what to expect. You may get that by the end of today, but it's most likely going to be that communication is going to come out tomorrow to you, where you can get back in touch with us and book that meeting with us. Okay.
Yeah, Jenny, you're right. I mean, the click on the button to go schedule a call so that it works with your schedule and ours is powerful. It makes it easy for us to be able to have that personal appointment with you. And no matter which one of the team is working with you, you get an opportunity to build a portfolio plan with them. It's invaluable. Please take advantage of that. Thank you, Jenny. I appreciate that. So I'd like to ask another question if I could. Hey, Denny Foster, you've worked with a lot of our friends out there. How's it going today?
Going great, Ben. Thanks for having me, and hello to everyone.
Hey, so I mean, you've worked with an awful lot of our clients. What kind of accounts can we do? You know, with Interactive Brokers and our partnership and what we do at TRADEway, what kind of accounts can our friends be looking at thinking to bring to AMP?
Yeah, we can pretty much do all types of accounts. We can do individual joint accounts. We can do retirement accounts. If you have a 401k, we can help you roll it over to an IRA with no tax implications. Um, Whether that be a regular IRA, a simple IRA, or a Roth IRA. And then, of course, we work with businesses. So if you have somebody that has a business and they have some money in an LLC or a corporation or something like that, we can also help them move their money over and trade for them at Interactive Brokers.
Yeah, it's a great point, Denny. And I mean, we mentioned it earlier, but sometimes, you know, people have started their LLC accounts and they figure out that, you know, the market data costs a lot. Hey, what if TRADEway were to do it for you? It's a great way for you to take advantage of the AMP services. So thanks for calling out, Denny. I'm looking forward to our friends being able to spend some time, being able to develop a plan with you as well. Thank you for that. Hey, David Verbugen, I've got another question. Can you help me out here? Sometimes this can be a little difficult to get things going, right? So, I mean, do our friends just have to figure this out on their own? I mean, what does that look like for us?
Yeah, guys, we like to help you going through the process. We have a whole team. There are CEMs, client engagement managers, and they're going to walk you through every single step of the process to get your account set up and funded, right? These can be complicated things, which is why we walk you through every single step, every single field that needs to be populated, every single button that needs to be clicked. We tell you what to do. So it's done the right way the first time. Stress is off your shoulders. So you don't have to worry about that because we're going to walk you through every single step of the process. And sometimes we get a lot of questions about, hey, so I've got this 401k and I'd like to roll it over to an IRA, but is that going to have a tax consequence? Not if you do it the right way.
Yes.
Another reason why it's important to have us help you, because we can make sure that we get that done the right way so there is no tax consequence. If you were to try and do that on your own and you fumble it, there could be a tax consequence. So anyway, we like to take this and just make it easy for you, again, stress-free, and help you out as best as we can.
Awesome. Thank you, David. And you're so right that the team of people that we have are so good at doing that. Getting the accounts started, getting them funded, getting the money moved. There can be some complexities and sometimes some obstacles. Let us help eliminate it and make this click button simple for you. Well, so I think that pretty much brings us to the close of what we had for today. But I do want to ask if there was any other questions that came up in the time frame. Was there anything in the chat box or the questions and answers team that we didn't get to?
Um,
Oh, here's
yeah.
one, a 457B. Yeah, a 457B is a type of retirement account. And typically what will happen is we just work with your custodian to try to roll those funds over into an IRA. And as long as you can roll them over, then yes, we can help you with the 457B as well. I can see that we have a few clients on here talking about how easy it's been for them to work with our team. I appreciate that feedback. Thank you so much. Scott, if you are required to be at a specific brokerage, I am not able to help because our tools are interactive brokers. IBKR gives the ability for you to grant our team discretionary trade authority. They really are our partners in this. It's their technology that lets us trade your account as if it is our own. So, and I think that pretty much covers out the majority of the questions. Here's what I'd like to just remind you of. Meet with one of us. You got questions about your specific examples, the things that are happening in your life. That is why we as advisors want to spend some time with you. Let us help you. Let's get engaged with the team. You can ask the questions. We can help explain some of these complexities. And together we can build a plan that helps you to know how to get started. Right? So go ahead and schedule a call with us. Let us have the conversations with you about the different portfolio options, the different minimums that we have within the different portfolio options. Let's get together and let's have a conversation about how our team can be a part of helping you to achieve your investment objectives. All right. Well, Jeffrey and team, it was fun to be on with you. Jeffrey, thanks for all your leadership, your help, and being able to organize this program. It's been great to be on with you today.
Well, yeah, Ben, I appreciate you leading out. And really, guys, I want to just reiterate that we are really excited about what we think AMPT is right now at the moment, but what it also can become. And so, most long-term portfolios, they say the average person will stay in that portfolio for about 10 years, Ben. And so when I think about that, I go, wow, I think this would be really cool for us to kind of look back in the year 2035, which seems so far out there, doesn't it, Ben? Like 2035, I start to think about, how old am I going to be? And I'm going to have kids and they're going to be how old at that point, in time, maybe grandkids, 10 years. So it's really kind of weird in some sense, but guys, listen, we would love to be in a spot to just really be a blessing to everybody that entrusts us with their funds. And we take that as a great privilege and responsibility. And we are working to really just try to make this program into something that really is like exciting for you. And I talk about this quite often, Ben, but the Bible says rejoice with those who rejoice. And so we would love to be in a spot where our clients were so thrilled that they were just rejoicing with us, and we could just be like, yes, that we rejoice with you. And so we really want that to be taking place, and that is our desire. And so I want you guys to know that we're working to do these things to create that environment where that becomes something that we'll be in a spot to be able to do. And so we want to try to be very wise. We're praying over what we're doing, and we're using the skill sets and the knowledge of this team to really do the best that we are capable of doing, and really appreciate you guys being on with us today. Look forward to these conversations. And of course, if you have any additional questions, feel free to ask those. And I think, Ben, they would just send those to amped@tradeway.com if they had any questions about anything we discussed today.
Yes, that would be the easiest way. Email amped@tradeway.com. Please make sure to include your name, your phone number, and it would make it very easy for us to be able to get back in touch with you. Awesome. Well, thank you, Jeffrey. I appreciate all of our friends being on today, and we'll see you again soon.
All right. Thanks, everyone.